Hello and welcome. We're so glad you're here today. I'm Pat Flood, President of Supreme Lending Southeast. Whether you're joining us for the very first time today or whether you've been a part of the Supreme Lending family for years, thank you for taking your time to be with us. We know how valuable your time is, and that's why we've created a power-packed session designed specifically for you, our real estate partners, who are out there every day guiding home buyers through one of the most important investment journeys of their lifetimes, buying a home. It's been a challenging 5 years in housing with so many variables beyond our control. First, COVID, lower interest rates than ever, bid past list price, price appreciation records, and then higher interest rates, higher taxes, higher insurance costs, and now the uncertainty of on again and off again tariffs. Through it all, we've done our best to remain optimistic, but realistic, grounded in one essential truth, that real estate agents who know more can offer more value to the clients that they serve. And that's why we've gathered here today, to provide you with the best insights possible into the housing and housing finance industries, and to equip you with the tools to better serve your buyers and your sellers. As the market continues to shift and evolve, one thing remains constant: the need for trusted advice. And today, we've got one of the very best to deliver it. Doug Duncan, longtime friend of Supreme Lending and former Chief Economist at Fannie Mae. He's joining us to share his expert take on the current housing and housing finance landscapes. You've heard Doug before. You know you're in for an insightful and engaging update. If this is your first time, you're about to see why he's one of the most respected voices in our industry. But Doug is not all we have for you today. As we wrap up today's session, we'll be revealing a brand new tool that's been purpose-built to help you better serve your customers on their home buying journey, especially customers buying for the first time. It's a fresh, powerful addition to our toolkit, your toolkit, and we can't wait to share it with you. So settle in, grab your notepad, and get ready. Let's dive into today's program with our special guest, Doug Duncan. Doug Duncan, welcome back.
Thanks for the invite. Glad to be here.
Yeah, so Doug, there is a cliche that all of us have heard in our lifetime. It goes like this: what goes up must come down. And I fully understand and appreciate, having talked in the past, that you've got 3 rules of forecasting you could share with us in here in just a minute. But we want you to break the rules today, because the number one question that everyone in the audience, all of our realtor partners, our associates, our customers, and really the number one question that President Trump has is, when is the Federal Reserve going to lower interest rates? You're on.
Well, the 3 rules are pretty well known. Actually, I have a plaque behind me that has the 3 rules on it. If you give a number, don't give a date. If you give a date, don't give a number. And if you get it right, don't look surprised. Unfortunately, if you're in the forecast business and you're honest, you put your forecast out on the forecast sheet, which I did for many years at the mortgage bankers and at Fannie Mae. And when people would ask, what's your real forecast? I would say it's printed. That's my real forecast. So when is the Fed going to cut rates? Well, yesterday, they made no change in the Fed funds target range, but they also released their quarterly summary of economic projections. That's when the 19 people that serve on the Federal Open Market Committee each give their opinion of what they think will happen economically. And in that opinion, between the March summary of economic projections and this June summary, there was no change in their expectation that there would be a 50 basis point cut in the Fed funds target range in the second half of the year. There were a bunch of questions about that during the press conference subsequent to their release, because their summary showed a decline in growth expectations and slight increase in unemployment, not completely slight increase in their preferred measure of inflation, and yet they still showed a 50 basis point cut in the Fed funds target rate. So that's the current thinking. I think that the Fed is keeping their options open, waiting to see what's going to happen with the tax and spending bill that's being negotiated on the Hill between the House and the Senate at the present point in time.
So we've got a lot of uncertainty, if you will, in the marketplace, which is really holding the Fed back right now. Tariffs and what that might wind up turning into, and as to whether or not that could add to what we've all experienced as inflation. Even though inflation's on its way down, there's that out there, that uncertainty. And then there's you just mentioned a tax bill, what everyone in America knows as the big, beautiful bill that's out there. And so those two things hopefully maybe get settled in the next 30 or 45 days and give us more certainty going forward. Is that really what the Fed is kind of looking at right now? Get those things behind us, be able to compute what they think those things mean, and then maybe they need to add some additional support to the economy vis-a-vis dropping rates?
Yeah, if you go back and look at the announcements that they make after each meeting, you will always find the word uncertainty or uncertain in there somewhere. The question is, because the future is always uncertain by definition, but the question is the degree of uncertainty greater or lesser than normal? And I think their view and my view is that uncertainty is greater today than is normal for a couple of reasons. One is there are a couple of pretty serious wars underway. Not that there's not always conflict in the world, but those two things are aligned with some important resource issues. Um, and the tariffs are something that we have not dealt with except briefly in the 2016 to 20 time period for more than 50 years. The tariffs have been in decline for over 50 years. So this is really a tectonic plate shift, and the responses of businesses and people who don't have experience with this are uncertain.
You know, one of the things that you and I have talked about in the past is that there's a historical spread, if you will, between the rate of inflation, the 10-year treasury, and most important for our audience, because those things would be in some way speaking a different language to them, but it's really about where mortgage rates are historically based on those ideas. And if the 10-year treasury today is 440, you've shared with us that roughly right, a little less than 200 basis points higher is where mortgage rates have averaged over a long period of time. That would, by the way, for our audience, that would have rates today not at 7 or 7.25, but it would have them closer to around 6.5. So there's some room for rates to come down even without the Fed moving, assume inflation stays and assuming some of these uncertain issues settle themselves, correct?
Yeah, and you do want to separate what the Fed does from what mortgage rates do, because if you go back to last September when they did the first 50 basis point cut, mortgage rates actually went up. So the fact that the Fed cuts the overnight rate at which banks lend to each other does not mean that 10-year treasuries or long bond rates are going to react in the same way. There is hope that they would move in the same direction if the Fed does cut rates, because the whole yield curve or the distribution of interest rates over time has moved up altogether. And so if they were to cut, one would hope that they would move back down. But I think that this question about the trade and the tariffs is going to probably be in the mix.
Um, Inflation is on its way lower, independent of the prognostication about tariffs and how it could turn that. It has been softening. I mean, we peaked out around 9, believe it or not, and now we're down in the mid 2s someplace. Target being for the Fed 2%, but we're slowly but surely moving there. And employment clearly is softening. The numbers are not as good as they were the last year or two. So if those two things are the mandates of the Fed, um, I think that's where the pressure comes from. We all know that about, hey, maybe we can lower rates at this point. That all being said, if you were the Fed chairman today, Doug Duncan, the Fed chairman, is just been announced, and he's you. Would you lower rates or lowered rates yesterday?
I would not have. I would have done what the Fed did, because I would be waiting to see what happened with the fiscal policy, the change in taxes and expenditures. A question came to the chair, which was a reasonable question. I think he gave a very good answer to. The question was, if you are data dependent, and as you just said, Pat, we've seen a slowdown in the pace of PCE core inflation. Why would you not cut? And he said, well, it's our view that we see a substantial buildup of inflation to come in over the next few months, and you don't act on what has happened in the past. You use that in combination with the things that you believe about the future to make your decisions.
Fannie Mae, Federal National Mortgage Association, which you were responsible as the chief economist for years, creating the construct that creates their monthly forecast for the next couple of years. They recently released their forecast, housing forecast, and they're suggesting that sales will be up in 25 by 4%, and again next year by 7%. And for everyone in the industry, those would be the first two improved years that we've had in 3 years. So to the extent that 4% isn't higher, we all want it to be, or 7% isn't higher, we all want it to be, but they are indeed improvements. So if you've stayed in the industry or got in the industry, it looks like, at least the forecast from here, is that things are going to get a little bit better because each quarter shows a bit of an improvement. And interest rates in their forecast, Doug, start around 7, which is where we are today, and they move lower to about 5.75 at the end of 2026 on 30-year fixed rate mortgages. Do you agree with the team's forecast? And maybe you could tell us a little bit about, if this happens, then it'll be better than that, and if this happens, it might not be as good as the 4 or 7%. What say you?
Yeah, I actually don't just look at the Fannie forecast, which obviously has some insight into how it used to be done, but I also look at what Freddie says, what the home builders say, what the realtors say, what the mortgage bankers say. So I like to, uh, that was kind of my practice each month when I was finalizing my forecast, is I would look at the others to understand if there were any things that I had missed, first of all. And second of all, where did they think the impulses were going to come from? That said, I'm struggle to get to 5.75 at the end of next year without a recession. And if there is a recession, rates would likely be lower than that. There is some pickup in supply, which has not been met by as strong an impulse on the demand side, because you're seeing nationally house prices slow. They're still positive, slightly positive, but they're slowing. Will there be some pickup in sales? Again, I'm going to hang my hat on the big, beautiful bill and tariffs. I really think those two things are a big issue. In the event that they are not able to reach an agreement on the bill, the third quarter could be very messy from a fiscal policy perspective, and you may well see rates shoot higher because of the risks that that puts into the marketplace, and that would probably be a precursor to a more recessionary environment where rates would come down, but so unemployment would likely go up. Now, working against that, there's two things I think that are useful to think about. One is the labor market is doing very well, and doing better than really was expected. And now we've basically shut off immigration. So in terms of labor force growth, there are going to be wage pressures coming at some point in the future because the immigrant population was very important to keeping the employment growth going and income and consumption going. So it's yet to see what's going to happen there. The second thing, which is not immediately showing up in U.S. mortgage rates and the housing sector, but which you might want to think about a little bit, is it's not just long-term interest rates in the United States that are going up. They're up in Japan, they're up in Germany, they're up in the UK. You could make some sort of an argument that bond holders and investors globally are starting a sort of a rebellion against deficit-funded growth. That brings me back to the big beautiful bill and why I see that as an important issue. I don't know if that makes sense, but I always like to try to see the big picture and then how does our piece of it fit?
What keeps me hopeful now is how we started. What goes up must come down, and what goes down usually goes up to more normalized numbers. We've been, for our audience's purposes, we've been at historically low numbers now on housing sales based on demographics for the last 3 years. So one should assume that at some point, a series of things are going to happen to have that return to some degree of normalcy. There's been very few markets that have been this depressed in the last 50 years. So how we're going to get out of it, we don't know quite yet, but it feels like somehow or another we'll find our way out. Which leads me to my final question I always ask you, Doug, which is one that I think has now made you famous with our audience because you're talking directly to all of their potential clients who are themselves dealing with all of the uncertainty. They're also dealing with, the price of housing, the price of food, the price of just about everything, including homeowners insurance having gone up. So they are about to considering making the biggest investment of their lifetime, and they need somebody to give them a way to think about, is it a good time to buy a home? You're that somebody. So my question to you again today, Doug, is it a good time, all things considered, now to buy a home?
If you have a household family budget and the terms of acquiring the house fit within that family budget, then it's a good time to buy because you're going to be a homeowner. If you're guessing about where interest rates are going to go or where prices are going to go, now you've moved into the speculator arena, and some people can afford to do that. The other beauty of having a budget is the lender, Pat, if you come into Pat's team and ask them to help you get a mortgage, they're going to ask you the questions that come right out of that budget. And so if you walk in prepared, you become a better customer for them and a wiser customer for yourself if you have that basic tool behind you.
Every time I ask you that question, it's like you're giving fatherly wisdom and advice to all of us, right? Grown adults as we might be. No, and I think people appreciate that because it takes the emotion out and makes it a practical decision. We all need housing, a roof over our heads. The question is it a good time to buy? The answer is that if your budget and what you're buying work together, then it's a good time to buy. Because if you buy at today's rates and they go up, as you've said in the past, you got a better deal. If rates go down, you can always refinance the mortgage and go down. For our audience's insight on this question, last Saturday, I was talking with Doug, maybe it was even Sunday. Happy Father's Day again, Doug. And we were talking, and Doug was on his way back from Virginia. He lives in Cape Coral, Florida. And what was he doing in Virginia? He was up there working as a guide for his son who's out in the marketplace looking to buy a home. And Doug is acting as the guide, I guess, based on being the chief economist at Fannie Mae for 17 years and being in the in the mortgage housing business your entire life, you'd be a pretty good guide to have. Not only is it a good time to buy a home, but how to actually do it right. And in our conversation, we talked about a couple of things, like the process of getting a structural engineer because the house was in 1969 built, and all the things about the maintenance of the property. You were giving him that great education and guidance. And then we shifted to our conversation, both of us, about the importance of having a family budget and the importance of improving your credit score if you could.
Absolutely true. And as we walked the property, for example, there was not an appropriate fence around the swimming pool that they had, which raises the question of the homeowner's insurance and liability coverage in that particular question. So I asked, have you talked to homeowners insurance agents about what the homeowners insurance cost would be on a property similar to this, and how is that reflected in your budget? So very practical, trying to walk through, are you prepared for maintenance on this? What's a kind of a cost that you might expect for annual maintenance kind of things on an older home versus on a newer home?
Yeah, and we'll finish here. I just read an article this past week. There was a survey done on all the folks that bought a home a year ago in America, and 50% of them were unhappy because they didn't fully understand and appreciate the cost of homeownership maintenance. They just were not informed going in. So, it's really important to get the right guide and the right information so that your journey as a home buyer, when it starts, you can be well informed, you have a budget, you'll then be much more satisfied, and you'll also have a lot less stress in your life financially. Doug, as always, we appreciate your insight and your wisdom, and we'll look forward to seeing you again in the middle end of July.
Great pleasure being with you, and best wishes to all you and all your clients.
Doug, thank you so much for being our guide today. And to our audience, thank you for being here today. Now it's time to introduce our brand new tool, the Supreme Homebuyer Journey, to equip all of you to guide your customers home. Take it away, Sharon.
Thanks, Pat. Hi, I'm Sharon, and I have the opportunity to introduce Supreme's newest tool designed specifically for you and your clients, the Supreme Homebuyer Journey. But before I begin, I want to be honest with you. I'm not real. I'm an AI avatar deployed by Supreme Lending for one simple purpose: to help you become the best real estate professional possible. Now, let's talk about the Supreme Homebuyer Journey. This brand new resource builds on the foundation of our Supreme Essentials program, which rewards your buyers with up to $1,000 in lender credits for completing budget and credit education. In just over a year, more than 3,000 customers have taken advantage of Supreme Essentials, saving money on their loans and becoming more confident, better informed homebuyers. That got us thinking. Buying a home is often the most substantial investment a person will make in their lifetime, and there's a lot to learn. Real estate agents like you already serve as guides to help clients make the best decisions possible. But let's be honest, many customers are embarrassed to admit they don't fully understand the process. They might not know what escrow is, or how much home they can truly afford, or what kind of inspections they really need. You get the idea. It's easy for us, industry professionals, to forget that our clients haven't taken a real estate exam. It's our job to help them feel confident and informed every step of the way. That's exactly what the Supreme Homebuyer Journey is designed to do. Rather than a course with quizzes or exams, this is a self-paced, ever-expanding video library that guides your clients step by step through the home buying process, from pre-approval to closing and beyond. And best of all, the content is searchable. Clients can simply type in a term and they'll be directed to the relevant video module and resources. Here's an example.
In this lesson, we'll discuss the importance of assembling a knowledgeable and supportive team to guide you through the home buying process. Firstly, selecting a great real estate agent is crucial. A skilled agent can help you find the right home, negotiate the best price, and navigate the complexities of the buying process. According to the National Association of Realtors, 88% of buyers purchased their home through a real estate agent or broker in 2022. Look for an agent with a solid reputation, local market knowledge, and excellent communication skills.
We thought you'd like that clip. After all, as a real estate agent, you're the team captain of your customer's home buying journey. The Supreme Homebuyer Journey breaks down key moments of a real estate transaction, explains complex terms in simple language, and helps buyers avoid common pitfalls. From budgeting and building credit to making an offer, reviewing appraisals, and understanding closing costs, the Supreme Homebuyer Journey is the resource you'll wish every client had before they ever called you. But wait, there's more. Just as we did when we launched our Supreme Essentials program, we've created this program with you in mind. We've developed a unique way for you to present the Supreme Homebuyer Journey, as well as all of Supreme's services, your very own Start With Supreme partner page, co-branded with your Supreme Loan Officer partner. It's a simple new way for you to offer all of Supreme's tools to your clients. That way, your clients will be able to recognize your contribution to their better-informed home buying experience. Simply scan the QR code on your screen and we'll help you create your co-branded suite of tools to better serve your customers. Thank you for joining us today, and we can't wait for you to share this valuable resource with your clients. Back to you, Pat.
Thanks, Sharon. Wait, why am I thanking an AI avatar? Everyone, thank you so much for joining us today. I trust you're leaving better educated and now better equipped with the Supreme Homebuyer Journey. You're better positioned than ever to help guide your customers home. We're honored to serve alongside of you. Best is waiting. Meet you there.